Stop for a second and look at this date, February 4th, 2026. Right now today, delegations from multiple countries are sitting in Washington, D.C., at the Department of State for the inaugural Critical Minerals Ministerial. Secretary Rubio is hosting. The official line is strengthening and diversifying supply chains for critical minerals. But when governments use those exact words, it almost always means one thing. We have a serious vulnerability and we need to lock it down fast. And silver is right in the middle of that conversation. This meeting is happening less than 1 week after silver's most violent crash in decades, 41% from $122 to the low $70s. Then, a sharp bounce back toward $85. Most people see that crash as the end of the story. I'm going to show you why it might actually be the beginning of something much bigger. Let me explain the stakes here. Critical minerals are the building blocks of modern life. Everything from batteries to defense systems relies on them. And silver isn't just a shiny metal for coins or jewelry. It's a strategic asset that's being consumed at record rates. The US government knows this, and that's why they're pulling together this summit with urgency. Delegates from key allies are flying in to discuss how to secure supplies before it's too late. This isn't a routine chat, it's a response to global shifts that could reshape economies. First, let's quickly recap what just happened, because the speed was unreal. Silver ran from $30 in early 2025, $122 by late January, over 300% in 13 months. That rally was fueled by a perfect storm: central bank hoarding, dollar concerns, and skyrocketing industrial needs. Gold hit $5,595 all-time high, riding the same wave. Then, in 1 week, margin hikes from exchanges, forced liquidations of over-leveraged positions, algorithmic selling that snowballed, single-day drop of 37%. Worst since 1980, when the Hunt Brothers saga shook the markets. Total wipeout, 41% to $72 lows. The panic was palpable. Forums filled with sellers regretting their timing, then bounce, 18% recovery in days, climbing back toward $85 as buyers returned. That bounce matters a lot. Dead assets don't bounce 18% with conviction. They grind lower or flatline. Real buyers stepped in, seeing value where others saw ruin. These weren't casual retail traders. They were entities with long-term views, betting on fundamentals. Now, let's look at what almost nobody is connecting. While the West was liquidating in fear, Eastern physical markets were doing the opposite. Shanghai spot silver traded at a 25 to 30% premium over Western benchmarks during the worst of the panic. That means, while Western futures were hitting $72, Eastern buyers were effectively paying equivalent of $90, $95 or more for physical delivery. Same metal, two completely different prices. Their worst-case futures prices at limit down were still $12, $18, higher than where Western futures were freely trading. Limit down halts trading to prevent total chaos, but even their halted low was above our active trades. That is not panic selling. That is strategic accumulation at scale. And it wasn't retail frenzy. It was calculated moves by institutions or state-linked buyers who see the bigger picture. Why pay more? Because they believe the paper price is artificially suppressed and physical scarcity is the real driver. Now add this: one of the largest Western precious metals trading operations, long dominant in New York and London, recently relocated a significant part of its desk and strategy to Asia. Not expanding their footprint, repositioning their core focus. This involves moving traders, analysts, tech infrastructure, a multi-million-dollar commitment. Institutions don't spend millions moving people, systems, and focus across the world on a whim. They do it when internal models show the center of gravity has permanently shifted. Asia is where demand is exploding, from tech manufacturing to reserve building. This bank is betting the future of metals. Trading is there, not in traditional Western hubs. Now put those three together. Eastern buyers paying big premiums during Western fire sales. Eastern futures floors holding well above Western crash levels. A major Western player moving east to be closer to the action. And then, on the exact same week, the United States government convenes its first-ever high-level critical minerals ministerial. Timing is everything in markets and policy. This convergence isn't coincidence. It's a signal that the crash exposed deeper issues. Silver is not just another commodity on that agenda. It is consumed, not stored in massive quantities. Over 650 million ounces went into industry last year alone. That's more than half of global production, vanishing into products that can't be recycled easily. Solar panels need silver paste for efficiency, and solar demand is booming with energy transitions. EVs use it in batteries, contacts, and wiring as electric adoption accelerates. 5G networks require it for high-frequency components. Semiconductors, defense electronics like radar and guidance systems, medical imaging like X-rays, all depend on silver's unique conductivity. No substitutes work as well at scale, and the world has run a supply deficit for years, using more than we mine. Stockpiles are depleting faster than expected. New primary silver mines take 8 to 12 years from discovery to production. Permits, funding, environmental hurdles, it's a slow process. Most silver is byproduct from copper and zinc operations, so even sky-high prices don't directly spur more silver output. Copper mines don't ramp up just for silver. They follow copper demand. That is the trap governments are waking up to. Supply can't keep up with demand, and geopolitical tensions make it worse. So what could come out of today's meeting? Possible outcomes include strategic national stockpiling programs like the oil reserve, but for silver and other minerals to ensure supply during crises. New bilateral supply agreements with friendly nations, locking in long-term deals with producers like Mexico or Australia. Incentives or fast-tracking for domestic mining tax breaks, streamlined permits to boost U.S. production. Export controls or restrictions on foreign acquisition of reserves, preventing adversaries from cornering supplies. Designation of silver or groups of minerals as strategic for national security, triggering protections and funding. These are not small policy tweaks. They are the exact steps countries take when they decide a resource is too important to leave to open market traders and speculators. China has already done versions of this with rare earths, gallium, germanium, export bans, and stockpiles. Now the US appears to be responding in kind. Here is the big picture I see. The paper silver market futures, leverage. Margin calls just had its violent divorce from the physical silver market. Actual metal needed for factories and defense, paper crashed 41% in a leveraged unwind. Physical barely flinched. Eastern buyers paid premiums. Floors held higher. That divorce is likely permanent for a while. It means two markets. One for bets and speculation, one for real atoms. Wealth transferred during the panic from leveraged speculators who sold in fear to patient accumulators who bought the dip. And governments are now waking up to the same reality. The physical stuff matters more than the paper price. Control the physical, and you control the future. What I'm watching this week, the official readout from today's meeting, any mention of stockpiling, silver specifically, or new agreements that could support prices. Any executive follow-up in the next 7 to 10 days, orders or announcements that turn talk into action. The Shanghai premium, if it stays above 20%, even as Western prices recover, physical reality is still leading the way. Price behavior, if silver holds above $80 IT, $5 and grinds higher, the shakeout worked and weak hands are out. Also watching broader market signals. If the dollar weakens or Fed hints at cuts, it could fuel another leg up. This is not the end of silver. It's potentially the clearing of weak hands before the next leg up. The 1970s gold parallel is still the best one. Gold ran to $200, crashed 50% plus. Everyone thought it was over. Headlines buried the bull market. Retail sellers dumped at lows. Then it went to $850, a 400% plus move for holders. The crash didn't kill the trend. It killed the casual participants. Same setup may be playing out here. The fundamentals, deficits, industrial must-haves, geopolitical grabs remain intact. The leverage and froth got burned off. Now the real players step in. Drop your thoughts below. Do you think today's meeting changes anything? Is the paper-physical split real and lasting? Are you stacking on this dip? I read every comment. The sharpest takes often come from you. If this connected some dots, share it with one person who needs to see it. And if you're not subscribed yet, hit that button. We're tracking this story as it unfolds. This is the hidden side of the economy. See you in the next update.